Today we're exploring the backbone of modern civilization, copper. From ancient tools to artificial intelligence infrastructure, copper enables every aspect of our electrified world. Over the next 15 minutes, we'll examine its supply constraints, explosive demand growth, recent price dynamics, and the strategic mindset driving both institutional and retail investment decisions. Copper's global supply, concentrated and constrained. The world has mined approximately 700 million metric tons of copper throughout history, enough to fit in a cube measuring just 430 meters on each side. With global reserves estimated at 1.2 billion metric tons, copper's scarcity becomes evident when compared to its ubiquitous applications. Annual mine production reached 23 million metric tons in 2024, but this supply faces unprecedented challenges. Production powerhouses. Chile dominates with 5.3 million metric tons annually, 23% of global production. Peru follows with 2.6 million metric tons, 12%. Democratic Republic of Congo produces 3.3 million metric tons, 11%. China contributes 1.8 million metric tons domestically, 8%. Critical supply reality. Despite massive capital investments exceeding $10 billion, major producers like BHP project flat production for the next 5 years. The average time from copper discovery to mine operation now spans 20 to 25 years, creating an insurmountable supply bottleneck. Unlike precious metals, over 50% of global copper reserves are concentrated in just 5 countries, with Chile alone holding 340 million metric tons, 28% of world reserves. This geographic concentration creates significant supply chain vulnerabilities. Demand, the electrification imperative. Copper's unmatched electrical and thermal conductivity makes it irreplaceable in the modern economy. With nearly 70% of copper used in electrical applications, demand growth is accelerating across multiple sectors simultaneously. Infrastructure and construction, 33% of demand. The construction sector drives copper wire demand through electrical systems, power distribution, and smart building technologies. Global urbanization and infrastructure modernization require massive copper installations that last decades. Electric vehicle revolution. The automotive transformation creates exponential copper demand growth. Traditional internal combustion engines use 23 kg of copper, while battery electric vehicles require 83 kg, a 260% increase. Electric buses demand 224, 369 kg, depending on battery size. By 2027, an estimated 27 million electric vehicles will be on the road, raising copper demand from 185,000 tons in 2017 to 1.74 million tons, a 49% increase in just 1 decade. Green energy infrastructure. Solar installations and wind turbines create permanent copper demand. Onshore wind turbines require 10 tons of copper each, while offshore installations can exceed 20 tons. Solar photovoltaic systems demand substantial copper wiring for efficient energy transmission and grid connections. AI and digital infrastructure, data centers, telecommunications networks, and artificial intelligence systems require massive copper installations for power distribution and cooling systems. The digital transformation creates structural demand that compounds with every technological advancement. The copper supply-demand crisis. Global copper demand is expected to grow by over 40% by 2040, but supply cannot keep pace. Meeting this demand requires bringing 80 new mines online and 250 billion in investment by 2030, an impossible timeline given current permitting and development constraints. The math doesn't work. Between 2018 and 2050, the world needs to mine 115% more copper than has been extracted in all human history just to meet business as usual demand, before considering electrification requirements. Universities of Michigan and Cornell research concludes that copper cannot be mined quickly enough to support current US policy guidelines for renewable energy transition. Structural deficits. Unlike cyclical shortages, current copper deficits reflect permanent demand destruction of available supply. Each electric vehicle, solar panel, and data center permanently removes copper from the available stock through decades-long applications. Geographic bottlenecks. China imports 60% of global copper ore and produces 45% of refined copper, creating dangerous supply chain concentration. Any disruption in Chinese processing capacity immediately affects global availability. Recent market dynamics: why copper hit 15-month highs. Copper prices surged to $5.04 per pound in October 2025, gaining 11.47% year to date. Unlike speculative rallies, this surge reflects fundamental supply-demand imbalances. Supply disruptions. Mining operations face increasing challenges from water scarcity, declining ore grades, and environmental regulations. Major mines in Chile and Peru experienced production delays throughout 2024, removing millions of tons from expected supply. Inventory depletion. LME copper inventories reached near two-year lows of 105,000 metric tons in June 2025, though recovering to 108,725 metric tons by July. COMEX inventories reached 21-year highs of 247,210 tons, but regional imbalances prevent efficient global distribution. Investment demand. Unlike industrial metals trading, copper now attracts major commodity trading houses like Vitol, which is building dedicated copper trading capabilities as a 3 to 5 year project. This institutional recognition signals copper's transition from industrial commodity to strategic investment asset. Investment perspectives: professional versus retail. Institutional challenges. Professional investors face unique copper investment obstacles. Extreme volatility with 30-40% annual price swings complicates risk management. Limited pure-play copper investments. Most miners extract multiple metals. Complex supply chain dynamics requiring specialized industrial knowledge. Regulatory and permitting risks affecting mining operations globally. Retail investor advantages. Individual investors can capitalize on copper's structural trends without institutional constraints. No need to justify complex industrial demand models to investment committees. Can utilize higher volatility for tactical trading opportunities. Benefit from copper's correlation with economic growth and electrification themes. Access through copper ETFs, mining stocks, or futures provides multiple exposure methods. Current institutional adoption. Major trading houses and commodity funds are building dedicated copper expertise, recognizing the metal's strategic importance beyond traditional cyclical patterns. This professional validation suggests copper's evolution from industrial input to investment asset class. Investment strategies and approaches. Direct exposure options. Copper ETFs tracking futures contracts or physical copper holdings. Copper futures and CFDs offering leveraged exposure, 25,000 LB contracts. Physical copper trusts like Sprott. Physical copper trust providing direct metal ownership. Equity exposure. Major copper miners including BHP, Freeport-McMoRan, and Southern Copper offer indirect exposure while carrying operational risks. Mining stocks typically exhibit higher volatility than underlying copper prices, but provide leverage to price appreciation. Portfolio allocation considerations. Copper's dual role as industrial commodity and inflation hedge suggests strategic allocations of 2 to 5% for diversified portfolios. The metal's correlation with economic growth provides natural exposure to global development themes while offering portfolio diversification benefits. Key investment reminders. Volatility management. Expect annual price swings of 20 to 40% with potential for extreme moves during economic uncertainty. Position sizing should reflect this volatility profile. Supply-demand fundamentals. Current market dynamics reflect structural rather than cyclical imbalances. Industrial demand growth consistently outpaces mining supply capacity increases, creating persistent upward pressure. Recycling limitations. While copper is 100% recyclable, current recycling rates provide only 30-35% of global supply. End-of-life copper recycling cannot scale quickly enough to offset growing demand from new applications. Regional considerations, geographic concentration in mining and processing creates supply chain vulnerabilities that affect pricing and availability. Geopolitical stability in key producing regions directly impacts investment returns. Time horizon matters. Short-term copper price movements reflect economic cycles and trading sentiment. Long-term appreciation depends on successful navigation of the supply-demand imbalance through higher prices, technological substitution, or demand destruction. Summary and strategic takeaways. Long-term outlook. Copper faces an unprecedented supply-demand imbalance that cannot be resolved through traditional mining expansion. Higher prices or demand destruction appear inevitable over the next decade. Investment thesis. The convergence of electrification, urbanization, and digitalization creates multiple simultaneous demand drivers, while supply remains constrained by geology, geography, and permitting timelines. Professional recognition. Institutional adoption of copper as a strategic allocation reflects growing awareness of its critical role in economic development and energy transition. Risk-reward profile. Copper offers exposure to transformative global trends while requiring careful position sizing due to inherent volatility and supply chain risks. Timing considerations. Current elevated prices may limit near-term upside, but structural demand growth supports higher long-term valuations as supply constraints intensify. For comprehensive copper market data and analysis, the International Copper Study Group and London Metal Exchange provide authoritative industry statistics essential for serious copper investors. Thanks for watching. If you're considering copper as part of your investment strategy, share your thoughts in the comments. Don't forget to like, subscribe, and hit that notification bell for more commodity and metals analysis. See you next time.